Have you ever wondered how some people manage to build substantial wealth without taking huge financial risks? What if there's a smarter way to grow your money that doesn't require you to gamble on volatile stocks or high-risk investments? In today's video, we're going to explore the top 8 smart ways to build wealth, methods that are low-risk and manageable for anyone. Whether you're just starting your financial journey or looking for safer ways to grow your money, these strategies are designed for you. Let's dive in. 1. Maximize employer-sponsored retirement plans. If you're employed and your company offers a retirement plan like a 401k, you're sitting on a powerful tool to build wealth. Contributing to this plan is one of the easiest and safest ways to secure your financial future. Many employers even match a portion of your contributions, essentially giving you free money. This is an automatic 100% return on your investment. In addition to employer matches, these plans are tax-advantaged, meaning the money you contribute grows tax-deferred until you retire. Over time, this can add up significantly, as you won't be taxed on your contributions or gains until withdrawal. The beauty of contributing to these accounts is that it's automatic. Set up a percentage of your paycheck and let time and compound interest do the work. Starting early and consistently contributing to your retirement account can help you retire earlier than you think, all without taking on any significant risks. 2. Invest in broad market index funds or ETFs. If you're nervous about picking individual stocks or try to time the market, investing in broad market index funds or ETFs, exchange-traded funds, can offer you a much safer route to building wealth. Instead of putting all your eggs in one basket, these funds provide instant diversification. Essentially, you're investing in the entire stock market or a broad section of it, like the S&P 500, instead of relying on the performance of a single company. By investing in a diverse range of companies, you reduce the risk of one company's poor performance significantly impacting your portfolio. These funds are generally less volatile than individual stocks, providing steady growth over time with less risk involved. Plus, they come with low management fees compared to actively managed funds, which means you keep more of your profits. For beginners, this approach is a great way to start investing without needing in-depth knowledge of the market. Since index funds and ETFs track the performance of the market, they typically provide reliable long-term returns, making them perfect for investors who want to build wealth steadily and securely. 3. Eliminate high-interest debt. High-interest debt, like credit card balances, can quickly drain your finances, making it harder to build wealth. If you're carrying debt with an interest rate of 15% or more, you're essentially losing money by paying interest instead of investing it. The sooner you can get rid of high-interest debt, the sooner you can redirect that money into savings or investments that will help you build wealth over time. One strategy to eliminate debt quickly is the debt avalanche method. This involves focusing on paying off the debt with the highest interest rate first, which reduces the amount of interest you're paying over time. Once that high-interest debt is paid off, you can move on to the next highest, continuing the process until you're debt-free. By eliminating high-interest debt, you can free up a significant portion of your income that would otherwise go to paying off debt. Once that money is no longer tied up in interest payments, you'll be able to invest it in wealth-building strategies, accelerating your path to financial freedom. 4. Build a high-yield emergency fund. Before you start aggressively investing, it's essential to build a financial cushion that can protect you in case of emergencies. A high-yield emergency fund can prevent you from having to tap into your investments when unexpected expenses arise. Ideally, aim to save 3 to 6 months' worth of living expenses in a high-yield savings account or money market account. This allows your money to grow while being accessible if needed. The key to this fund is to keep it separate from your main investment account so that you're not tempted to dip into it for non-emergency expenses. By keeping your emergency fund in a high-yield account, you ensure that your money grows steadily while you focus on building wealth through other channels. Having a cushion of savings means you won't have to sell your investments during a market downturn or tap into your retirement funds early. The peace of mind that comes with having a solid emergency fund is invaluable, and it allows you to take on more long-term investments without the fear of needing immediate cash. 5. Utilize tax-advantaged accounts, ISA/Roth IRA. Tax-advantaged accounts like Roth IRAs or individual savings accounts, ISAs, are fantastic tools for building wealth in a low-risk way. These accounts allow your investments to grow either tax-free or tax-deferred, which means more of your money stays invested and grows over time. In the case of a Roth IRA, you won't pay taxes when you withdraw your funds in retirement, which can lead to significant savings. By contributing to these accounts regularly, you're making your money work for you without worrying about taxes eating into your returns. This is especially helpful if you're investing for the long term, as tax-free growth accelerates your path to building wealth. Additionally, many of these accounts have annual contribution limits. So by maximizing your contributions each year, you're optimizing your ability to build wealth steadily. For beginners, opening a tax-advantaged account is a great first step. These accounts provide a reliable way to invest while minimizing tax burdens, and they come with fewer risks compared to other types of investments. 6. Practice dollar cost averaging. Automate everything. Dollar cost averaging, DCA, is a strategy where you invest a fixed dollar amount at regular intervals, regardless of market conditions. Whether the market is up or down, you stick to your investment plan and continue buying. This removes emotion from investing, preventing you from making irrational decisions based on short-term market fluctuations. By automating your investments, you ensure that you're consistently contributing to your portfolio without worrying about the best time to buy. This is particularly helpful for beginners who may not have the time or experience to monitor the markets closely. DCA helps smooth out the impact of market volatility by buying more shares when prices are lower and fewer when prices are high. This approach ensures steady growth over time, and by automating your contributions, you reduce the temptation to make emotional decisions during market dips. The result is a well-rounded, diversified portfolio that builds wealth gradually, without the need to time the market perfectly. 7. Invest in yourself. Upskilling. One of the best ways to build wealth without taking on big risks is to invest in yourself. Increasing your earning potential by gaining new skills, certifications, or even degrees can open up higher-paying job opportunities. Whether you choose to learn a new language, gain technical expertise, or pursue a professional qualification, investing in yourself offers a high return on investment. The more skills you acquire, the higher your earning potential, which means more money to save and invest. This allows you to build wealth with less financial risk, since you're using your own abilities to increase your income. Plus, the return on upskilling is often more immediate than traditional investments, as better-paying jobs become available to you. Consider investing in online courses, workshops, or mentorship programs that can enhance your skill set. By improving your personal value, you're not just increasing your chances of earning more, you're also strengthening your financial foundation for the future. 8. Reinvest dividends. Instead of taking cash payouts from your dividend-paying investments, consider using a dividend reinvestment plan, DRP, to automatically reinvest those dividends into more shares. This strategy takes advantage of compounding by allowing your investments to grow at a faster rate. Over time, the dividends you receive will automatically purchase more shares, which in turn will generate even more dividends. This strategy works best with stable, blue-chip stocks or funds that provide consistent dividends. It's a low-risk way to build wealth, especially when the stock market is volatile. By reinvesting dividends, you're growing your investments without having to put in additional money yourself. The beauty of DRPs is that they allow you to accelerate wealth building without taking on more risk. By continuously reinvesting your dividends, you can watch your wealth grow steadily, even during market downturns. And that's a wrap. These are the top 8 smart ways to build wealth without taking big risks. By following these strategies, you can create a solid financial foundation that works for you without the anxiety of high-risk investments. If this video helped you, make sure to hit that like button, share with your friends, and subscribe for more tips on building wealth. Thanks for watching, and see you in the next one.